Good morning to you both. Jurrien, I'll start with you. I mean, we had that FOMC meeting a week ago. Chair Powell was much more hawkish. The expectations coming out of that meeting were more hawkish. And since then, the Fed speak has continued to get more hawkish. And yet, at least until today, we did see equities rally. Your take on this dynamic within stocks and the markets right now, especially as we do see the bond market signaling a very different story than equities?
Well, good morning. So the Fed certainly has continued to move the goalposts, right? So first it was going to be a terminal point at around 2%, then it moved to 2.25. Now we're at 2.75. And I've always, maintained that I don't think it matters whether the Fed went 25 or 50 in March or whether it went 4 times or 7 times in 2022. What matters is where the cycle ends. And until very recently, and just the last few weeks ago, the market always believed that the Fed would end around 2%. And, if you have, even if inflation moderates to, let's say, 4% from 7%, that would still leave the Fed very, very accommodative in real terms. And that doesn't really square with, the inflation numbers and the Fed's obviously intent to tame that inflation. So the Fed is moving the goalposts, which makes sense. But what the market is doing, it's agreeing with the Fed. You look at Fed funds or LIBOR curve or OIS swaps, they're all going to 2.75 now in the next year or two. But then you're starting to see rate cuts priced in. And at this point, we're pricing in 2 rate cuts after that 2.75. So I wonder if the market is looking through even a more hawkish Fed, maybe under the belief, whether it's correct or incorrect, that the Fed will indeed slay the inflation beast and then start to ease after that, and maybe the market finds some comfort in that.
So just to dig into that a little bit deeper, Jurrien, I mean, we are seeing this tug of war between bulls and bears right now in the market, and it's not necessarily clear what the narrative is. Where do you fall, and what does that mean in terms of where you'd be putting money to work? I
think that early low when Russia invaded the Ukraine at 41.15 on the S&P, that was a major impulse low, and I think that low will probably hold. I think the main issue for the market is a valuation derating, right? The PE ratio, the price was down about 15% at that low. The PE ratio was down about 25%, and even like the free cash flow yield is up to 4.3% now, which is pretty good. But as often happens during these periods of Fed tightening, and we certainly saw that in 1994, just to dust off the old Greenspan playbook, is that the market, just sits in a holding pattern for, possibly 6 to 12 months. And what we're seeing right now is something very interesting, that as I look at a lot at the discounted cash flow model, which, plugs in earnings growth, which continue to grow. So that's a very good piece of news there. Earnings growth is expected to be up 10% this year, and that number is holding in pretty firm. But what's happening is, of course, the risk-free rate, the 10-year yield, is soaring to 2.4%, and that should bring the discount rate up for the DCF model, bringing down the fair value for the market. And I have downside risk potentially to about 3,800 if that were to come to pass. But what's happening so far is that the equity risk premium is completely offsetting the rise in the 10-year yield. And as a result, the market is kind of staying in balance.
Shepard Smith here. Thanks for watching CNBC on YouTube.